Okay, March 28, 2016, we just covered an extensive video series on understanding negative interest rates, which turned into really more of a study on currency wars. And we're going to give an update to that at the end of this video. But I wanted to go through, here we are nearly 4 months in 2016, and revisit the resistance and support levels. If you recall from my market updates in the past, the red numbers are the support levels, market going down, and the blue numbers are the resistance levels. If we look at the S&P 500, you can see here this is the year, and the 1860, this was that support level that we really paid attention to. We breached it briefly and came right back up, which simply means that it truly was a support level. On the 1990, we had talked about that being a resistance level on the upside. You can see it here that we kind of hovered and we moved above it. But once above it, we've been basically moving sideways. So if you recall from previous videos, I talked about if we moved up to this 1990 level and ricocheted off with a high fractal dimension, then that would open up this 1520 lookout below scenario. Well, we've avoided that for now, but the 1990 remains an important resistance level. So we are up at this level up here in the 2033. Really, the next resistance level is 2105. And we have no danger in hitting that. There's really nothing going on that's going to push the market up higher to that level at this point. So what I thought would be helpful is to really look at what's been driving the market up really since, let's call it 2013. What's been driving the market up since that time? And I'm going to use an analogy to answer that question. Let's say in your own household, let's say that you have your income, you're bringing in $10,000 a month, and on the expense side, you have $7,000 a month in expenses. And of that $7,000, let's just say that your mortgage is $2,000. Now, if something happened that you had, your income got slashed to $7,000, you just got this 30% cut, and you're down to $7,000. Now, 7,000 in, 7,000 out, that's pretty tough to deal with. What do you do? Well, not all of us are in control of increasing our income, so we have to manage the expense side. Now, the problem is that we can cut some things out of our expense side, right? So maybe, we cut cable, or we stop going out to dinner more, as frequently. But a lot of this stuff is essentials. One of the things that we are able to do in a low interest rate environment is we can do what? We can refinance the house, and maybe we're able to knock that mortgage from $2,000 down to $1,500. Well, that certainly helps, okay? But that is a one-time scenario. You just can't keep refinancing over and over again. So now let's pivot over to the corporate side, and let's understand what earnings per share is. Earnings per share. So earnings, this is your net income that a corporation has. So this is the portion of a company's profit that is allocated to each outstanding share. So it's net income divided by your outstanding shares. So let's just go through some math. Let's say that our net income is $250 million, and we have 300 million shares outstanding. Well, that would equal a 83-cent earnings per share. That's how that is managed, okay? So when you watch CNBC or any of the other money channels, you have that ticker tape, right, that runs through the bottom of the screen. And I always watch that during the earnings report, the corporate earnings report, because as it's going through, it just has the company's name, right? So it's ABC Company, and it always has this kind of vernacular. It says, missed rev, met EPS, right? So what it's saying is that ABC, on their quarterly report, the company missed their revenue target, but they met their earnings per share, okay? So what that means in the household here is your income got slashed from 10,000 to 7, but you were still able to manage this over here. How were you able to manage in the near term? Well, let's say you did the refinance. So how has corporate America addressed this? Well, you have on the revenue side, and you have your expense side. If you're struggling here on revenue, what can you do on the expense side? Well, you can manage expenses just like we do in the household. What's the big thing that corporations have been doing? They have been eliminating the number one cost in any company, and that's payroll. So they downsize. They cut employee headcount. Now, as you can imagine, you can only do this so much, just like you can only refinance so many times. What's another way? If you've done this, what's another way that you can adjust this earning per share formula? If you can't increase your net income and you can only do so much to expenses, what about your outstanding shares? Well, you can do what's called a stock buyback, which means is you go into the marketplace and you buy your shares back. So let's say you go out and you buy 50 million shares. So you go from 300 to 250 million shares. Well, numerator, denominator, right? 250 divided by 250, it's no longer 0.83, it's actually 1. So by simply reducing the number of shares you have, you can increase your earnings per share just by math. And this has been what's really been driving the market, specifically the last 2 years. Let's take a look at this chart. So the red line are S&P 500 buybacks, and the blue line is the S&P 500, the actual index, the market return. So you can see red line is driving blue line. Over the past 2 years, $500 billion of stock in the S&P 500 companies has been purchased back for a total of $2.1 trillion since 2010. But with this picture, folks, guess what? You can only do this so much. You can only buy back so much. You can only refinance your house so many times. You can manipulate your earnings per share, but you know what? If you keep missing revenue, if your household, after you refinance, if you get slashed again down to 6,000, you know what? There's only so many things you can cut. What's the main driver of all this being able to occur? Zero interest rate policy, ZIRP. You can thank the Federal Reserve for that. Back to the resistance and support levels, this stock buyback slowdown is going to really make it difficult to push the market higher. It can happen. Now, in other videos, in other updates, I've talked about the race, right? There's a race going on. We have here in the US, we have slowing growth that matches the absolute stall in growth in Europe, China, and Japan. Now, as this stalls and we have these currency war issues, right? We just got through educating you on how you devalue your own currency is by selling your currency and buying what? Buying US dollars. That drives your currency down, which makes your exports more competitive in the marketplace. So, as money comes out of a bank in Japan or Sweden or China and goes in US dollars, often that money comes over to our shore in US dollars, and this is part of the race. The race is, can this money fuel enough US stock market growth as our growth in earnings per share and revenue continues to go down? That's the race. That's a tough question to answer. When you look at the upside versus downside potentials, remember, markets do one of three things. They go up, they go sideways, or they go down. Most of you watching this video that do not have your money managed by us, the only way you make money is when the markets go up. Why? Because Wall Street, whether it's Merrill Lynch, Edward Jones, whoever it is, has convinced you to buy and hold. That's why, as you're watching CNBC, you're seeing all these analysts saying, yeah, even though the U.S. growth is slowing, it's time to buy at the low and, things are going to turn around. Why? They have an agenda, right? And their agenda is they make money because you buy and hold. You may be saying to me, well, Rob, don't you have an agenda? Well, sure. But we make money whether the market's going up or going down. We just want what? You've heard me say this many times. We just want a trend. right? And the reason I bring this up is there are a lot more things pointing to a downtrend than there are pointing to an uptrend. So buyer beware in these circumstances. Okay. All right. Hope this was a helpful update. Keep your eye out for the BrinkmanAcademy.com for other videos. Thanks for watching.